On the 2nd of October, 1878, a single notice in the morning papers ended the City of Glasgow Bank. The doors of its branches stayed shut. Depositors who had trusted it for decades stood in the street with no answers. For years, the bank had paid generous dividends and looked like one of the soundest institutions in Scotland. Behind the polished counters, its accounts had been quietly rewritten. This is the story of a respectable bank that kept two sets of books, of the loans that should have sunk it long before, and of the autumn its own directors were marched to the dock in Edinburgh. The City of Glasgow Bank was founded in 1839 to serve a port that was booming on tobacco, cotton, iron, and ships. It grew fast. By the 1870s, it had become one of the largest branch networks in the United Kingdom, with well over 100 offices spread across Scotland. Its head office sat in the commercial heart of Glasgow, near the Trongate and Virginia Street, surrounded by the warehouses and counting houses of the merchant city. To ordinary savers, it looked like permanence itself. Its shares were widely held by tradesmen, widows, ministers, and small businessmen who treated the stock as a safe place to keep their money. There was one feature of the bank that almost nobody thought about while times were good. Like most banks of the era, its shares carried unlimited liability. That meant a shareholder was not merely risking the money he had paid for his stock. If the bank failed and could not meet its debts, every shareholder could be called upon again and again until the losses were covered or he himself was bankrupt. In a flourishing bank, this was a distant abstraction. In a failing one, it was a trapdoor. Most of the people holding City of Glasgow shares had no idea how far they could fall. The rot did not begin with the public. It began with a handful of large customers and the bank's own decision to keep lending to them long past the point of sense. Enormous sums went to a small circle of merchant firms trading on the far side of the world. The money chased speculative ventures, sheep and cattle stations in Australia and New Zealand, plantations and trading houses whose fortunes rose and fell with distant markets. As those ventures stumbled, the borrowers could not repay. Rather than write off the losses, the bank advanced still more, hoping the next season, the next shipment, the next boom would finally cover the whole. A large slice of the bank's exposure also rode on American railways. In the 1870s, railway shares and bonds from across the Atlantic were the great speculative prize of British finance, promising fortunes as the United States laid track from coast to coast. When the wider panic of 1873 tore through American railroads and crashed their securities, paper that the bank had treated as solid wealth lost much of its value. The City of Glasgow Bank was now holding heavy advances against farms it could not sell and railway stocks it could not cash. On any honest reckoning, it was already deep in the red. Faced with a balance sheet that told the truth, the men running the bank chose to change the balance sheet. Investigators later found that the published accounts had been deliberately doctored. The figure for deposits was understated, gold reserves were reported far higher than the bank actually held, and bad debts that should have been written off were dressed up as sound assets. A clerk prepared honest figures from the books, and they were altered on instruction before the public ever saw them. The annual report told shareholders the bank was strong enough to pay a 12% dividend, while the real position behind it was catastrophic. The deception did not stop at the printed page. To keep its share price from sagging and raising suspicion, the bank quietly bought back its own stock through secret arrangements, propping up a market that should have been falling. False statements about its gold holdings were given to the authorities. Each move bought a little more time and dug the hole a little deeper. For several years, the public saw a confident, dividend-paying institution. Inside the head office, a small group of directors and managers knew they were running a bank that was, in plain terms, already insolvent, and they kept the doors open anyway. No amount of creative bookkeeping could conceal an empty vault forever. As confidence cracked and the truth began to leak, the bank could no longer meet its obligations. In early October 1878, it suspended payment, and the news swept through Glasgow and beyond. Crowds gathered at the shuttered branches. Trade in the city seized up as firms that banked there or relied on its credit found themselves cut off overnight. A wave of business failures followed in the bank's wake. When examiners finally opened the real books, they found net liabilities running into millions of pounds, a sum that would equal hundreds of millions today. Now the trapdoor opened. Because the shares carried unlimited liability, the shareholders, not just the directors, were liable for the bank's debts. The call went out, and it was ruinous. Of around 1,200 shareholders, all but a few hundred were wiped out completely, stripped of homes and savings to pay for losses they had never known existed. Families that had thought themselves comfortably provided for were reduced to nothing. The scale of the suffering shocked the country. A national relief fund was raised by public subscription, eventually gathering hundreds of thousands of pounds. To help the innocent shareholders the bank had dragged down, public anger demanded accountability, and this time the law answered. In January 1879, the bank's directors and its manager were brought to trial before the High Court of Justiciary in Edinburgh, in the same Parliament House that had housed Scotland's Supreme Courts for centuries. The charges centered on the falsified balance sheets fabricated by some and knowingly published by others. The case gripped the nation, a rare spectacle of respectable financiers standing in the dock to answer for the figures they had signed. The evidence laid bare exactly how the honest accounts had been turned into a comforting fiction. The verdicts came at the start of February 1879. The manager and one long-serving director were found guilty of falsifying and fabricating the balance sheets and were each sentenced to 18 months in prison. The remaining directors were convicted of uttering and publishing accounts they knew to be false and were given 8 months apiece. To some, the sentences seemed light against the scale of the ruin, yet the principle was striking for its time. Bank directors had been held criminally responsible for the truth of the numbers they put before the public, and they had gone to jail for breaking it. The collapse left a mark on British finance that long outlasted the prison terms. The spectacle of blameless shareholders ruined by unlimited liability convinced Parliament and the banks that the old arrangement was indefensible. Within a year, the law was changed to let banks adopt limited liability, capping what a shareholder could lose to the money he had actually invested. The disaster also hardened expectations around honest accounts and independent audit. The City of Glasgow Bank had shown, in the most painful way possible, what happened when the people keeping the books answered to no one but themselves. Nearly a century and a half later, the story still reads like a warning written in advance. A trusted institution, glowing reports, a generous dividend, and underneath it all, a set of numbers that simply were not true. The City of Glasgow Bank did not fail because of one bad year. It failed because the men in charge decided that hiding the truth was easier than facing it, and because the structure around them let that lie stand far too long. When the doors finally closed, the bill fell on the people who had believed the figures. It usually does.